all of the institutional currency that's out there, they own right now just this tiny percentage of gold in their portfolios. There's very few of them, but now we're seeing some of them announce that they're going to start putting gold in their portfolios. They're going to start. They haven't, the flood hasn't come yet. And these are the places it's going to come from. All you have to do as a small investor is be along for their ride. And you're going to do very, very well. You're putting yourself on the right side of this wealth transfer. Hi, this is Mike Maloney, and I'm here with Jeff Clark again, Senior Precious Metals Analyst at goldsilver.com. Jeff, how are you doing?
I'm doing great, Mike. It's great to be back with you again this week, of course. And we have some interesting things to talk about. So let me just dive right in if you don't mind.
Sure, go right ahead.
This first article caught my eye yesterday. It was an article that Ron Paul had written, and I think you'll have a reaction to it. I met Ron Paul, maybe 10 years ago or so, had my picture taken with him, got to talk with him for a little bit. I really like Ron Paul a lot. He's one of the few honest politicians that are out there, in my opinion. But anyway, in this article, he said that some Fed officials are claiming they want, quote, tougher banking regulations to prevent investors from taking, quote, excessive risks and creating asset bubbles. But Mike, is more banking regulation really the issue? Is that really going to solve the problem? I mean, really, what causes bubbles in the first place? Is it a lack of regulation?
The Federal Reserve. The Federal Reserve is the source of all bubbles, and it has been since 1914. The Federal Reserve Act was passed in 1913. That's the date you normally hear, but it was November 1914 that they actually opened their doors for business and started manipulating the economy and expanding the currency supply, causing wealth transfers, causing a greater inequality between all of the different parts of society. And now they're in the business of creating centibillionaires, people that have more, they're in the business of creating multi-billionaires, centibillionaires, and very shortly, trillionaires. In the next big crisis, when they try to reflate the stock market and they create all of these, the brand new currency, they shove that into the banking system and the brokerage houses, and you'll see the stock market go up by the same percentage at about the same time that the currency is created. That's a transfer of wealth by diluting the currency supply and giving it to the pushing up the stock markets, because they think that the stock market is the economy. And there's this big confusion. In this century, everybody equates the stock market doing well with the economy doing well. And it's not true. Right now, we have the stock market doing well, and the rest of the economy is not doing. So there's a big, huge disconnect here. And it isn't investors. Most of the trading that goes on Wall Street is black box trading, and it's one brokerage house selling to another brokerage house back and forth in microseconds. And they're all just trying to take a quarter of a penny here and a quarter of a penny there. And it can add up to some really big numbers, but this high frequency trading is the vast majority of the trading that's going on. It's not the brokerage house, the pension funds and so on, and people with their 401ks, their IRAs. They take a position and they usually hold it for some period of time. And when you look at the volume, that's almost none of the volume. They do have an investment in the market, so they do see a little bit of benefit when the market goes up. But when you're creating dollars, and Jeff Bezos no longer owns 16% of Amazon, but he used to own 16%. When you create dollars, and one of the biggest stocks as far as market cap in the S&P 500 is Amazon, and you give these dollars to brokerage houses by taking mortgage-backed securities and U.S. Treasury bonds off of their balance sheets. You put cash on their balance sheets. They look for higher yielding instruments than what was just purchased for them. And when they invest in the stock market, they usually do it through ETFs, exchange traded funds. And those exchange traded funds are typically like the S&P 500. So the value of the new currency, it gets its purchasing power by diluting the currency pool that's out there. And so anybody holding currency, like you and me, are basically, wealth is transferred away from us and it's given to whoever owns 16% of Amazon.
Right.
But it forces things into a massive bubble. If you look at the value of the Wilshire 5000 total market cap index, I wish I had just the market cap of the S&P, because that's through these ETFs. That's really where everything flows to. It flows to just a few stocks. It doesn't flow to the broad market. So it isn't pushing up the stocks of small publicly listed companies that might be located in your town. It's pushing up just the stocks of the S&P 500 and causing them to go into this enormous bubble. And when you look at the market capitalization of the Wilshire 5000 compared to the size of the economy, the bubble has never been bigger in all of history. It's a massive, massive bubble, and it has nothing to do, absolutely nothing to do with individual investors. And more regulation just slows everything down and makes it, there's all this compliance and all of these forms that have to be filled out, and organizations have to be able to afford to hire another person to handle all of this compliance. And so that's a burden on the small organizations. For the big organizations, they're going to love extra regulation because they can afford the compliance, and it puts the small guys out of business, so they gain market share. But the bubbles are purely caused by the Fed, and they have nothing to do with the individual investor that took a position in specific stocks through their pension fund or through their 401k or IRA, and then did not trade it back and forth 10,000 times a second. The value that's currently in the stock market is this bubble that it's been pushed into, is the big brokerage houses trying to get rid of the excess currency that they've been given by the Federal Reserve, which was just created from nothing and stole purchasing power from all of us. So there is the long answer to a short question.
Right. The bottom line is they're not looking at the root cause. And until they look at the root cause, regulation isn't going to really fix anything. It's not that some regulations are all bad. It's that regulation isn't the source of the problem. It's not the cause.
The guys at the Federal Reserve do not understand fundamental economics. And so therefore, if they're ignorant of fundamental economics, then they're incompetent and they don't belong in their job. If they do understand fundamental economics and this wealth transfer and how these bubbles are caused, then they are complicit and they belong in jail. So the two places that they belong is either fired or in jail.
Right. I think those that should be fired are going to get in for a rude wake-up call here someday soon, Mike. So, by the way, our friends at Peak Prosperity have actually interviewed Ron Paul, and I believe that's going to be on their site today, so you can head over to peakprosperity.com if you want to check that out. So, okay, let's move on to the next question, Mike. And that is this article that says roughly 1 in 3 full-time workers have experienced a pay cut due to coronavirus issues due to the pandemic this year. And then on top of that, of course, you have a lot of people, millions that are unemployed. So I'm not going to ask you to comment on that, but the question I have in response to that is, Mike, who's going to buy all this gold and silver and push prices up higher if you have, a third of Americans with lower income and millions that have no job? How are gold and prices going to see this, gold and silver going to see this big demand and push prices higher?
Okay. You and I were writing a book together and it got stalled because some more important things got in the way. However, I did a big study on this. There's a whole chapter on it. And it's, in the last answer, you asked me, who creates these bubbles? You asked me, the Federal Reserve wants to implement more rules and regulations to try and prevent people from taking these unnecessary risks and speculating in the stock market, and that was causing these bubbles. Well, all of this currency that the Fed created goes somewhere. You take a look at any of the currency supply statistics, and the currency supply has expanded hugely, and most of it is parked. It's in savings accounts, it's in money market accounts, but it has gone to all of the people that already had big portfolios. It didn't trickle down to Main Street. Some of it did with these checks for the relief of being out of being fired out of work. There's a lot of government stimulus going out there, but when you take a look at like MZM, which they call money of zero maturity, it's not money, it's currency. When you take a look at that, that is measuring the big accounts. That's measuring stuff that's in the brokerage houses and stuff like that. When you do quantitative easing and you buy an asset from a brokerage house or a pension fund or a non-bank entity that had an asset that the Fed bought, and they shoved cash on their balance sheet by buying this, now that entity has too much cash and not enough of the assets that they're supposed to be invested in, so they go out and they buy more assets. And you can draw a direct correlation between currency creation and the value of the stock market. And as the stock market gets pushed up, it enriches the people that are holding a lot of stocks. So the person that is already a multimillionaire, a hectamillionaire, I guess you would call it, or a centimillionaire, or a billionaire, or a hectabillionaire, somebody with $10 billion or more, or a centibillionaire like Jeff Bezos and Bill Gates. They're the ones that as soon as they see inflation and the stock market's crashing, all of these people that have enormous amounts of assets that were given to them by the Federal Reserve, they were stolen from you and I, given to them by the Federal Reserve, but they're going to want to protect them. They don't understand that the Federal Reserve committed this theft on their behalf, but they are definitely going to want to protect what they've got. And, gold has been one of the best performing assets of this century. In fact, I've got a chart on it here, so we'll bring that up. And here is, since the year 2000, the S&P 500 is the red line at the bottom, and gold is the blue line at the top. And gold was up over 700%. It's pulled back to where it's up 600% from the year 2000. But the stock market is barely up more than 150%. And so right now, gold's performance in this century is 4 times what the stock market has been. The main indice that's used as a measurement of the stock market. So that's another, again, a long answer to a short question.
That's a good answer. I think what some investors tend to forget, and I've written a lot about this, is just how small the gold and silver markets are. I mean, the gold market is a piece of lint on Warren Buffett's suit. I mean, it's just tiny. He could buy every registered ounce of gold at the COMEX with something like 10% or less of his cash, every ounce of registered gold. The silver market is even smaller. It's ridiculously small. The point is that it doesn't take a lot of cash or funds coming into those markets to impact their price in a great way. And don't forget, it's not that people may have less income, it's that they'll be desperate to find some kind of monetary solution in the middle of a crisis, in the middle of inflation, or whatever the situation might be. And so I do expect, regardless of what's happening right now with the virus and unemployment and reduced incomes, I do expect gold and silver prices to be impacted in a great way whenever this next crisis hits.
Yeah, and the upper middle class and the rich and the uber wealthy are the ones that are going to get more and more wealthy, while the people that don't have stocks are going to be affected by that don't have stocks and can't afford gold and silver. The people that are unemployed and so on, they're going to be the ones that suffer the most. And that's all because of the Federal Reserve. But one more thing that you have pointed out is that all of the funds, the pension funds and the different investment funds and all of the institutional currency that's out there, they own right now just this tiny percentage of gold in their portfolios. There's very few of them, but now we're seeing some of them announce that they're going to start putting gold in their portfolios. They're going to start. They haven't, the flood hasn't come yet. And these are the places it's going to come from. All you have to do as a small investor is be along for their ride. And you're going to do very, very well. You're putting yourself on the right side of this wealth transfer.
That's a good point. It's not just retail investors, it's institutional that obviously have a lot more funds to invest than the retail. And like you said, they're just now starting to get involved. So any kind of panic, and those guys will be swarming in. As long as we own gold and silver before that happens, we will benefit. And that will be a fun day. So, well, Mike, thanks. This has been a great little video. So thanks for joining me, and I'll see you again real soon on the next one.
Thank you, Jeff.